This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
An area of law which I don't often cover is the area of loan capital. And loan capital is covered in Chapter 13 on page 93 of the course notes. Can you just take a moment or two to read through page 93, and I'll start again in a couple of minutes. Okay. A debenture is the written acknowledgement of a debt by a company. Debentures may be also known as loan stock or loan notes or simply company debt. So they can go under any one of these names, and each of them is not unusual, and particularly not in an F3 or an F7 accounts question. Normally in F4 your examiner will refer to them as debentures. They may be secured or unsecured, and it may be a single debenture or a series of debentures. The single debenture is typically where money is borrowed from the bank, and the bank will ask for security against this loan, and the company will then provide the bank with a debenture. It will issue a loan note and specify and identify the particular security. Either the company or the bank is then able to register this mortgage, this charge over the property. Any interested party, in fact, can register it with the Registrar of Companies, and in the situation of a single debenture borrowing money from a bank, it is most likely that the bank itself will wish to register the charge in order to protect its own interests. An alternative will be a series of debentures. This is where the company invites the public, or more than one person, to subscribe, normally in lots of £100 or multiples of £100, to subscribe and lend money to the company at a declared defined rate of interest. Each of these people who register and lend money will buy a debenture, sometimes at a discount, so they may pay only £90 and get a £100 loan note in exchange, or sometimes even at a premium, where they may, for instance, pay £104 and only get a £100 debenture note in exchange. You may ask why anybody would want to pay £104 in exchange for the acknowledgement of a debt owed to them of only £100. Well, that could be because the company is prepared to pay a rate of interest greater than the normal rate of interest paid by companies on debts owed by them. If the normal rate of interest were, say, 6%, then our company, our borrowing company, may be prepared to pay, for instance, 7%. So the lenders are going to get a better rate of return on their loan, and may be therefore prepared to pay a premium when that loan note is issued. If the debentures are issued in a series, then the lender Abdul and the lender Givila rank equally amongst themselves. The Latin expression is that they would rank pari passu inter se, and it doesn't matter whose name comes first, whether it be Abdul or whether it be Givila. Debentures in a series rank equally amongst themselves. This is important in the context of a liquidation, that in a liquidation situation where a floating charge debenture is the last people to be paid, then we want to make sure that Abdul and Givila are treated equally. Of course, in a liquidation, the floating charge debentures rank quite high up in the list of priorities for the liquidator to be paying out the debt. But what I'm saying is that if the company doesn't have enough money to pay completely this tranche or this level of creditor, then it's important that the level of creditors rank equally amongst themselves. The debt may be secured or it may be unsecured. If it's an unsecured debt, then even then the lender, the debenture holder of an unsecured debt, still ranks higher in a liquidation than the highest ranking shareholder. So they are better in terms of risk-free attraction than even the best shares. The security may be fixed or floating. Whether it is fixed or floating will be identified within the register of mortgages and charges, and the difference there is also quite important. Whichever the method, and I will come back to fixed or floating in a moment, whichever the method of security, whether it be fixed or floating, in order for the charge to be valid and to be recognized by a liquidator in a subsequent liquidation, then this charge must be registered with the Registrar of Companies within 21 days of its creation. If it's not registered, then the debt becomes repayable immediately. So it's in the company's interests to register within the 21 days in order to prevent immediate repayability. In addition, it's in the lender's interests, because if it isn't registered, then it ranks as an ordinary unsecured trade creditor and falls down the list of priority in terms of payment in a liquidation. If there are two charges over the same property, say a fixed charge and a floating charge, the fixed charge will always take precedence, no matter the fact that it was created maybe 2 or 3 years after the floating charge was granted. If there are two charges which are similar, so two fixed charges or even two floating charges over the same property, then the earlier one will take precedence, and the earlier one is the one which was registered first with the Registrar of Companies. It may in fact not be the earlier one. If Aaron were to lend money on the 1st of May on a fixed charge and registered it on the 20th of May, meanwhile Brian lent money on the 4th of May and registered it on the 12th of May, then Brian will take precedence over Aaron on the basis that Brian's charge was registered first. There is a small exception to that, and that is that if Brian knew, if he were told by the directors, or if it were written within his debenture document, if he were told that his was a secondary charge, then he cannot improve his rights simply because of an administrative defect on behalf of the primary lender. Debenture holders are creditors of the company, they're not members. So in a liquidation, they need to be paid off before any of the members or any of therefore the equity or the preference shareholders. Coming now to the different types of charge, fixed and floating charges. Fixed charges attached to specific assets, typically assets which are immovable, so I have in my mind easily a factory or a warehouse or an office building or even an investment property. So fixed charges attached to property which tends to be immovable. However, there's no reason why a fixed charge should not attach to, for instance, an aeroplane or a ship or a bridge. So although buildings are the easy ones to think of, it could attach to anything which is of a permanent nature and not likely to be disposed of by the company in the near future. Once a piece of property has been pledged as security on a fixed charge debenture, the company is no longer free to deal or dispose of those assets. In addition, imagine a company is facing insolvency in the near future. It may look at an existing creditor that they have been dealing with for 20 or 30 years and with whom they have a good working relationship, and they owe this creditor a substantial amount of money. For the company to go into liquidation, it's going to hurt their, inverted commas, friend. So what they may seek to do is create a fixed charge or even a floating charge over a piece of their property or one of their assets in favour of this existing creditor. Now, such a fixed charge created within the 6 months prior to the commencement of a liquidation may be held to be invalid, and a subsequently appointed liquidator within that 6-month period will seek actively to try to prove invalidity. A receiver, however, who may have been appointed by the fixed charge debenture holder, may alternatively seek to prove that it is valid, and can do so if he can show that either the charge was created in exchange for new money coming into the company, that it wasn't given in exchange for an existing debt, or secondly, he may prove the validity if the company was solvent at the date of creation of the charge. That is, even though no new money was coming in, nevertheless the company was in a position to pay its debts as they fell due. In the event of a liquidation, a fixed charge debenture holder ranks number 1 in the sequence of asset distribution. Actually, technically correct, they rank first equal. Imagine a liquidator being appointed to the office of liquidator. Are you thinking that maybe the liquidator is prepared to do this job for nothing? Well, surely not. Any assets that the liquidator realizes in order to be able to complete the liquidation, out of those assets the liquidator will take his fee. So the liquidator will get the fee, but what about our fixed charge debenture holder? He will actually physically be holding the title documents to the charged property, and there's no way that he's going to give those charged documents, those title documents, to the liquidator. So negotiations will follow. He'll probably transfer the title documents to the liquidator on condition that the liquidator acknowledges that the debt will be repaid out of the proceeds of those charged assets. Insofar as the proceeds of sale are insufficient to satisfy the fixed charge debt, then the excess will fall down and rank on the same level as the unsecured trade creditors. If proceeds exceed the debt, plus the outstanding interest, then the liquidator will pay the debt and the outstanding interest out of the proceeds to our fixed charge debenture holder. Any surplus will then be kept by the liquidator for the purposes of adding it and accumulating it with all the other cash inflows, in order that they can then determine which of the remaining creditors should be paid and by how much. If a floating charge exists over an asset, then there may be a negative pledge clause within the floating charge. Assume that there is no fixed charge in existence. The company borrows money secured by floating charge, which I'll explain in a moment or two. That floating charge, in a situation of a liquidation, will rank second behind any fixed charge created over the same property. Now, if mine is the first debt, if I have lent money secured by floating charge and there is no fixed charge in existence, then I can write into the contract, or I can have written into the contract, a negative pledge clause. And the effect is this: if the company now seeks to use that charged asset to secure a fixed charge loan, before they can do so, they must notify me. Now, in that situation, I have a choice. Do I want my debt repaid, or am I prepared to let it live, and the fixed charge holder will take priority over me in a liquidation? It seems to me that I would probably ask for the debt to be repaid. In the context of floating charges, unlike fixed charges, these do not attach to specific assets. They were defined in the case re Yorkshire Woolcombers as a charge on a class of assets, present and future, where the class changes from time to time in the ordinary course of business, and the company may deal with these assets until the charge crystallizes. Typically, it applies to the current assets of inventory and debtors or receivables. Whether a charge is fixed or floating is not a matter of nomenclature or the title that we give it in the document. It's a matter of commercial reality, and the courts, in the case re Tunbridge and in the case re Cymex, determined that a fixed charge was in fact floating in Tunbridge, and a floating charge was in fact fixed in Cymex. A floating charge will be invalid the same way that a fixed charge was invalid if created within 6 months of the commencement of a liquidation. A floating charge will be invalid if it were created within the 12 months immediately prior to the commencement of a liquidation, with the same 2 exceptions. If the company can show that the floating charge was granted in exchange for new money, or that at the date the charge was created, the company was solvent and immediately able to pay its debts as they fall due. Debentures as compared with shares. Just let me ask you a question before I get into this. If we have equity shares and preference shares and debentures, which would you prefer? If you had £10,000 to invest in a company, would you have equity shares, ordinary residuary shares, at the end of a liquidation, or would you prefer preference shares, a fixed rate of dividend, preferential entitlement to repayment in a winding up? Or would you alternatively prefer debentures, which classically will have a rate of interest which is rather lower than the rate of dividend that maybe the preference and or the equity shares could hope to receive? So which would you prefer? Just put down your preference, and then let's look at the alternative attributes of these 3 elements. Okay. Rate of return. There's no guarantee that the equity shareholders are going to receive any dividend at all, and in fact they can't receive a dividend if there are not profits available for distribution. If there are no distributable profits, then the equity shareholders will get no dividend at all. With the preference shareholders, again, there's no guarantee, because again they are dependent upon there being distributable profits in the company, and if there are no distributable profits, then the preference shareholders will not get their dividend. Debenture holders, however, they will receive interest. It's not a dividend, it's interest. This is a charge against profits, pre-tax profits. And even though the company is making losses, the debenture holders will still receive their interest. Still on the rate of return, debenture holders' rate of return is fixed. It's fixed according to the debenture document, the debenture trust deed. And so there's no variability, there's no excitement. They will still continue to get their 4%, 4%, 4%, 4%, 4%, and so on ad infinitum, or at least until the debenture is repaid. Preference shares, their rate of dividend is also fixed, but of course they will only get their dividend if there are distributable profits. So although their rate of dividend may be worse than the equity shareholders' rate of dividend, at least it's a regular one. However, there is no guarantee, because if the company is failing to have any distributable profits, then the preference shareholders will not be paid any dividend. Equity shareholders get a variable rate of return dependent upon the dividend proposed by the directors. Hopefully, and possibly ideally, the directors will try to keep increasing the dividend year by year, improving the rate of return. But rate of return for shareholders is not confined to dividends. Rate of return for shareholders should be measured more reasonably on what's called total shareholder return. And as the share price increases, the company could justifiably reduce the rate of dividend because the aggregate or total shareholder return has improved. With reference to voting, equity shareholders, yes, but preference shareholders, no. Debenture holders, no. Preference shareholders typically don't get votes, and debenture holders, being creditors of the company, they have no voting, unless they also happen to be equity shareholders, but that's in their capacity as equity shareholders rather than as debenture holders. Security. It's most unlikely that the equity shareholders will have a secured interest, and certainly the preference shareholders have no secured interest. But the debenture holders normally would have. They don't have to, the debenture may be unsecured, but normally they would have security. The right to protection as a result of that security is not applicable for the equity shareholders, not applicable for the preference shareholders, but normally the debenture holders will have the right to appoint a receiver to recover their money for them. So there's a nice bit of strength and a bit of security for the preference share, for the debenture holders. Repayment and liquidation. I mentioned just a moment or two ago that on a liquidation, all the debentures, whether they be fixed, floating, or unsecured, will be repaid in full before any shareholder. Any shareholder, they will be repaid certainly before the equity, but also they will be repaid before the preference shareholder. But if we now consider the preference and the equity shareholder, equity is defined as those providers of capital who have a residual interest in the assets of the company after all debts have been paid off. The equity shareholders therefore rank last in a liquidation payment. The preference shareholders, the word preference tells us that they have a preferential entitlement to a dividend, but also a preferential entitlement to repayment in a liquidation. So they will come before equity, but after debentures. And equity shareholders last of all. So they rank lowest of the low in a repayment situation in a liquidation. However, if there happens to be a surplus on a liquidation, the debenture holders are not going to share in that, but equally, nor are the preference shareholders. Any surplus on a liquidation, after everybody has been paid off, including after the equity shareholders have been given their £1 nominal value back, then if there is any surplus left, then that will be distributed amongst the equity shareholders. Attend company meetings, and therefore have a say in appointment of directors. And again, yes for the equity, but no for the prefs and no for the debenture holders. So looking at this little list and comparing preference shareholders with others, the preference shareholders are no guaranteed rate of return because interest is payable to the debentures. But if there's no profits, then the debenture holders won't get any. They will get a dividend if there is enough money to pay one dividend, either the equity or the preference. It will be paid to the preference shareholders, but no guarantee. And in the event that the company is not in good financial position, then it could be the case that the preference shareholders do not receive their dividend. So in this situation, I think it's fair to say that the debenture holders are probably preferable on the basis that they will get their interest every year, whether or not the company is making losses or profits. Rate of return, I don't know about you, but whenever I have invested money, my excitement is waiting for the dividend to see whether the dividend this year is going to be better than last year. It's one of the exciting bits about owning shares. Even though you may only own 200 shares here or 500 shares there, it's still nice to receive a dividend. Sometimes the dividend is only for a few pence, or sometimes it's worth £1 or £2, but it's still interesting. One of the I would say, boring things about being a debenture holder. One of the boring things about being a preference shareholder is that you know that the interest you receive as a debenture holder will always be the same amount. And you know that if you do receive a dividend in your capacity as preference shareholder, it will always be the same amount. So this volatility, this variability of equity dividend is, in my view, a positive, and certainly more positive than the preference shares. Votes. If I want to have a say in the running of my company, then I need to be an equity shareholder. That gives me a preferential entitlement over my preference share colleagues and over the lenders, the debenture holders of the company. Security, I take a gamble. As an equity shareholder, I'm gambling my money, and in the event of a disaster at the company, I will receive nothing back. I may receive something back as a preference shareholder, but there's no guarantee. But if I were a debenture holder, I would normally have security, and that would therefore guarantee that I should get something back. And the right to protection. As an equity or preference shareholder, I can't appoint anybody. I'm meant to look after my own interests. But a debenture holder can appoint a receiver, and that seems to me to be an advantage that the debenture holder has over both the other classes of shareholder. Repayment and liquidation. Again, debenture holder wins it. They get their repayment before any shareholder receives a single cent. Surplus in a liquidation. The equity shareholders will participate in the surplus. Debenture holders no. Preference shareholders no. Attending company meetings. Yes, it's the equity shareholders who can and do attend and who do vote and who do therefore have an active say or potentially have the right to an active say in the running of their company. Not for the preference shareholders and not for the debenture holders. So, those of you that selected preference shares as being your preference, with reference to rate of return or with reference to both rates of return, debenture holders beat you in one and equity shareholders beat you in another. Reference to votes, I would prefer to be equity. With reference to security, I'd rather be a debenture holder. Right to protection, if that's what I want, then I need to be a debenture holder. Repayment and liquidation, if I want to guarantee insofar as I can that I will get my money back, then I need to be a debenture holder. If I'm thinking that the company, if it does go into liquidation, will have a surplus of funds, then equity shareholder is the one for me. And if I want actively to participate in the management or the deciding as to who should be management of the company, then it's got to be equity shareholders. In fact, I think it's reasonable to say that our preference shareholders are pretty unattractive. They certainly hold no attraction for me. So my choice now is, do I wish to be active or do I wish to be passive and secure? And this is now going to come down to a personal attitude. Am I a risk taker or am I risk averse? And that's a personal matter between people who choose to put their £10,000 as an investment into a company. If I just get rid of this, then we can look at the typing on this page and see. I think we'll find that it says pretty much what I've just written into the debenture column. Let's have a look. Debentures, fixed rate of interest, payable even though there's no profits. It's interest, it's not a dividend. Whereas the shareholders will only get their dividend if profits have been achieved. No votes. Security, but not always. Preferential entitlement to the return of money. Preferential compared with preference shares and equity shares. And possession of the charged assets. And if the company defaults, then they have a right to apply to the court for a liquidation order, or to appoint a receiver. They often have the right within the debenture trust deed that they themselves can appoint a receiver without reference to the court, or appoint an administrator. Which would you rather have? I know which I would rather have. And that brings me to the end of loan capital.